Precision trading often comes from recognizing patterns that most traders completely overlook. Look at this chart for a moment. Notice how price repeatedly drops into support and then suddenly expands higher with strong momentum. Most traders try to buy the first bounce and get stopped out repeatedly. The deeper truth is that institutional positions are built long before the real move begins. If you continue trading without understanding that accumulation process, you are always late. But by the end of this video, you will understand the reclaimed order block framework used in professional execution models. Let's get started. Now we are focusing specifically on reinforced order block theory and reclaimed order blocks. And to understand this properly, we will first examine the market maker buy model. But here's where most traders become confused. Look at this chart. The market begins by moving lower first. That downward movement reaches into a support area on a higher time frame or an immediate support reference. Now that support can appear in several forms. It might be an old high. It could also be an old low. It might come from a bullish order block. It could also be a filled imbalance, or even price moving into a fair value gap. Any of these elements can function as a valid support level. But here is the key concept. We are anticipating the market to move lower first, and then eventually expand higher. Now watch this carefully. Sometimes you will observe the market dropping into that support level in real time. If that happens, you may even participate by taking short positions during the decline. But here's something extremely important to understand. If the decline has already occurred, and you only notice it after price has reached support, that is perfectly acceptable. Because at that point we begin searching for specific levels where reclaimed order blocks may appear. But before we can do that, we must understand the sell side of the curve within a market maker buy model. Look at this chart again. The sell side of the curve is simply the downward move into support. And this becomes extremely important, because market makers do not enter their positions all at once. Their position sizes are much larger than those of retail traders, so they must scale into their positions gradually. That process is called hedging. Now pay attention to what happens next. As price continues to decline toward the support level, the market makers begin accumulating long exposure early. And you can actually see this happening in price action. Look closely at these small movements. As the market drops lower, you will repeatedly notice small temporary rallies. These short-term moves higher create minor swing lows, and this is not random. These small reactions represent early accumulation by institutional participants. In other words, smart money is quietly building long positions. But here is the mistake most traders make. They see those early rallies, and they believe the bottom has already formed, so they enter long positions too early. And then they get stopped out when the market continues falling. Now this changes everything, because those early rallies are not the final reversal. They are simply hedging activity. The real support level where the market will launch higher often comes later in the move. So each time price forms a small rally during the decline, we focus on something very specific. Look at this candle. We referenced the last down candle before that small rally. That candle becomes a bullish order block, but remember the context. This is happening during the sell side of the curve. Now watch what price does next. The market continues making lower lows. But every time a short-term rally occurs, we identify another down candle before the move higher. Those are bullish order blocks forming during the decline. And this is the foundation of the market maker buy model. The entire concept is very simple. The market moves lower first, then later it moves higher. That is all the market maker buy profile really represents. But the important detail appears later, and we will come back to that shortly. Eventually the market reaches a major support level. And once that happens, we begin seeing stronger buying activity. This is when the buy side of the curve begins. Look at this chart again. Now the market starts producing higher highs. And this is where reclaimed order blocks become powerful. Remember those down candles created earlier during the decline. Each of those candles represents institutional hedging activity. And once the market transitions to the buy side of the curve, those same candles become potential entry levels. But here's something extremely important to notice. Every new buying opportunity will often align with one of those earlier down candles. Those previous order blocks become reclaimed levels. Now let's define this clearly. A bullish reclaimed order block is a candle that was originally used to accumulate long positions during a decline. When price later returns to that level and reacts again, the market is reusing that same institutional reference point. Now watch this example carefully. Look at this chart. The market begins dropping from this level. This forms the sell side of the curve. Here you can see a down candle. Right before this small rally higher, notice the displacement that follows. That small movement indicates early hedging activity. The market makers were accumulating positions. But price continues falling afterward. Eventually the market reaches its true low. Now watch what happens next. Price returns to that same down candle. Right here, the level is reclaimed, and immediately price begins moving higher. That is the first example. Now look at the next level. Here we see another down candle before displacement. That movement higher confirms institutional hedging again. Now we are on the buy side of the curve. Price revisits that same level, almost exactly to the pip. And then the market expands higher once again. Those are two examples of reclaimed bullish order blocks. But now we need to look at the opposite scenario. Because the same logic works in reverse, now pay attention to what happens next. We move to the market maker sell model. This is simply the inverse situation. Instead of the market moving down first and then higher, we now expect the market to move higher first and then lower. Look at this chart. You may notice the market creating a high. And from that point you anticipate a decline. So we shift our focus to the buy side of the curve. Now this becomes very interesting. Every up candle that produces a small downward displacement afterward reveals something important. It suggests that market makers are hedging by selling short early. Look closely at this move. Those small declines after rallies indicate that short exposure is being built gradually. This process can continue for quite some time. And remember something important. Institutional traders have far deeper capital reserves. They can hold positions much longer than retail traders. So they continue scaling into short positions during rallies. But here's where the opportunity appears. Once the market reaches the sell side of the curve, meaning the high has formed, the structure begins shifting. Now every time price rallies back into an up candle from earlier in the move, that candle becomes a bearish order block. And those levels can be used for new short entries. Now watch this example. Look at this chart. This large up candle appears right before the decline. Price later trades back into it and immediately sells off. Here is another example. This up candle initially looks like a bearish order block, but price actually moves through it and forms a climax high. Now something important happens. When price later trades back into that same candle again, it becomes another short opportunity. Now look at this next example. This final strong up candle appears right before the drop. Price returns to it later, and again the market moves lower. This confirms that hedging had already begun earlier. And those same levels become reclaimed bearish order blocks. So in summary, the logic is actually very straightforward. A bearish reclaimed order block is a candle that was previously used by institutions to build short exposure. A short-term decline afterward confirms minor displacement. Later, when price returns to that level, the block becomes a new entry point for short positions. Now this becomes very powerful when you combine the market maker buy model and sell model, because both frameworks allow you to align order blocks across both sides of the curve. And once the reclaimed mechanism occurs, the market makers are simply returning to the same price references they used earlier. These levels become areas where new positions are facilitated. If you backtest this concept, you will begin seeing real-time examples before the move actually happens. And you will learn how to map these structures in advance. But for now, focus on studying these examples carefully. Go through your own charts, look for rallies and declines, mark every up candle during rallies, and every down candle during declines. Then observe how often price later returns to those same levels. You will begin noticing excellent trading opportunities that most traders completely overlook. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below. Let us know which topics you would like to see covered next. We truly appreciate your support, and we look forward to seeing you in the next episode.